Hi, welcome back. Today I'll talk a little bit more about investing and the difference between stocks and bonds. Stocks are companies, and bonds can either be from a company or from the government. So, stock is partial ownership in that company, and a bond is more like a loan that the company or the government makes, and you buy that loan and then they pay you interest. That's a bond. The reason you want to be more invested in growth when you're younger is because you have time on your side. The market will go up and down, and given enough time, it'll overcome the ups and downs. In other words, you'll have time to recover if the market crashes or whatever. This is why you want to be more growth oriented when you're younger, and as you gradually get older, you'll gradually make things more conservative investing. If you're close to retirement, the last thing you want is for the market to crash and your stocks all go half in value. What you'll do is ideally you'll come up with a ratio of stocks and bonds, and typically it's like 70% stocks, 30% bonds when you're very young, 60% stocks, 40% bonds, middle age. And then as you get closer to retirement, you reverse that and you're more invested in safer, more secure things that don't fluctuate in value all that much as you get closer to retirement. One way to do that is to use your age as the percentage. So if you're 25, you want to be, say, 25% in bonds and 75% in stocks. When you're 50, you want to be 50-50. If you're 65, you want to be 65% in bonds and 35% in stocks. That's a simple way to do it. And when I say to rebalance it, say once a year, someone asked, well, why would you sell your winners? Well, they're winners, but they're only winners on paper. They don't actually become winners until you sell some of it. So say your stocks have done really well and your current ratio is 60-40, 60% stocks, but now stocks represent 70% of your portfolio. So you're going to sell off. So in other words, you're going to take that profit, lock in that profit. Otherwise, it's just a paper profit. So you're going to lock in that profit, bring it back down to 60%, and invest the rest in bonds. So in other words, time overcomes risk. So the things that have the most growth potential also have the most risk of fluctuating up and down. So the most risky would be things like what they call penny stocks. Then you have growth stocks, which don't pay much in dividends, but they're designed to reinvest the company's profits into the company and grow the company. So then the value of your stock grows. And some companies are like utilities are good at paying dividends. Well, they're not in the growth business. They're there to take their profits and pay dividends to the shareholders. In bonds, you have corporate bonds. Those would be from companies. Municipal bonds, which would be from the government, a local or a state government. Local are generally local tax-free. And then there are junk bonds. Junk bonds are obviously a higher risk, but then they pay more of an interest rate to compensate for that risk. And bonds, ideally, you want to buy and hold them till maturity, just like a CD or something at a bank. But you can sell them before they mature, but they're going to go up and down in value based on what interest rates have done. The most safe thing, obviously, is a bank savings account, but then they don't pay much interest. It's safe, but it's not going to beat inflation. So you have to take inflation into account for your long-term investing. If you just stick your money in a savings account, you're going to lose because inflation's at 8% and you're only earning 0.5% in your savings. Your money's going to lose value over time. There are also government treasuries, which are very safe, but then again, they pay a fairly low interest rate unless you go out to like a 10-year treasury note. So you're going to beat inflation by investing in growth things. Gold will help beat inflation. And when it comes to gold, you're going to buy coins or bullion, the little bars. I don't mean jewelry. If you're going to have a stock portfolio and bonds and so forth, you don't want to be a day trader where you're sitting there and all you do is sit there and trade. You're going to get eaten up by the fees of trading, and you're just not as good as the experts. And they have computers buying and selling stocks that can buy and sell on a fraction of a second for a fraction of a penny, and that's how they make their money. You can't possibly beat them. So you want to be a buy and hold. The ideal thing would be to quarterly review your portfolio and make adjustments. And if not quarterly, then at least annually meet with your investment advisor and readjust things. And that's it for today. Hit subscribe and go to my website, rockledgerinc.com, and buy my book, Understanding Money. See ya.